Hi, this is Brian Bowen with Integrity Financial Planning. I wanted to talk about Section 1031 exchanges. That is a exchange of investment property that you would like to, that you actually hold for trade or business and use for an investment, but you would like to sell it but not pay the tax. So you can kind of trade up, diversify, or even consolidate properties and defer tax on the recaptured depreciation or capital gains. So that sounds like a lot, right? But basically, when you own a property, let's say you paid $1 million for it, and there was $200,000 worth of land, that $800,000, you were probably getting in the beginning a $30,000 deduction on your taxes, which helped you on your taxes every year. But guess what? You got to pay it back. So your cost basis might have been reduced from $800,000 down to zero if you owned it longer than 27 years for a residential property, at least. If you have a zero cost base, you go to sell the property, you might on $1 million property have to pay upwards of $300,000 in tax, or $240,000 tax, whatever it may be. You are going to owe some massive amount of taxes. So a 1031 it's what I'm surprised at is a lot of real estate investors know what it is but have never done it and own millions of dollars of tax of real estate. And it's because there's a little bit of moving parts. And it is a deferral. It's not an elimination of tax. It's a deferral. So some of the things that you need to pay attention to is that you have 45 days to identify the next property. And you need to roll the proceeds from your relinquished property into buying your replacement. Now, the purchase price and the mortgage on the replacement must be equal or greater than that of the original. If you receive cash, like non-like-kind property mortgage relief in the exchange, the value of that boot is taxable. So, you can combine a 1031 exchange with an installment sale to defer tax on the boot. But there's a lot of rules, and there's also things that you could do is what's called reverse exchanges, where it lets you buy your replacement property up to 180 days before you sell your existing property. Reverse exchanges, I've never heard of anyone actually know what those are. And so you need an accommodation title holder to hold title to the replacement property. However, it's a great way if you find a property before you sell it, because most of the times in this market, it's not hard to sell. It's hard to find. So reverse exchanges certainly can help you do the exchange and do it correctly. You just need someone to help you. And now a lot of people go, well, where's the money go? Well, it goes into what's called a qualified intermediary, and that, or QI for sure. The QI basically holds the money and can hold it up to 6 months while you wait to close on the next property. But here's a nice little tip that might help you. When you go to, let's say you're retiring, and at 65 years old, you've got this $1 million property, you're selling your business, or maybe you're retiring at your job and you've got this $1 million property and you want to sell it. So you don't want to pay the tax, but you do need the income still. You love the income of the rental, whether it's an office building or whatever it may be. Maybe it's a bunch of single family rentals. You sell the property and you don't want to manage it anymore. So there is something that you could do, which is also known as a tenant in common, or you also have the tenancy in common, which is basically a fractional ownership in a larger property. You don't want to manage it. You don't want to take out the trash. You don't want to fix the toilet, and you don't want to kick out the tenants when they don't pay the rent. You're tired of that. You've been doing that for 30 years. So that's one way, or a beneficiary interest in a Delaware statutory trust. And the 1031 exchange allows you to defer the tax, keep it in real estate, still get the income from the property, because we know real estate is very nice at cash flowing, and you don't have to go back into the same kind of property, right? So you could go from a multifamily apartment building to self-storage. You go from land that doesn't cash flow, usually, into apartment buildings or single family homes, as long as it's an investment property. And then if you kept it in your name, you could then pass it on to the next generation. And that would be beneficial how? Well, if current law, you're able to get what's called a step up in cost basis. And that step up in cost basis, when you pass, it goes to your next generation, whether it's a spouse or family member, friend, whoever is inheriting, does not pay tax on the capital gain, and all the depreciation recapture is gone. So that is a tax-free way to, and real estate gets all the benefits when you're managing it, right? Because you're able to get the depreciation. Then you sold it, you didn't pay the tax. And then when you actually pass away and the next generation inherits it, you didn't pay any tax there either. So it's really a great way to invest, but exiting is so important. So pay attention to the next video where you can learn about opportunity zones. And opportunity zones is another way to defer the tax and get some tax-free benefits when you sell. But this is different. You can do it after you sold the property. Listen to our next video.